Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me remotely, we have Rob Almeida. He's the Global Investment Strategist over at MFS, and we're going to take a look at the COVID-19 virus and how it's impacting the market overall. And Rob thinks that we should not be laying the blame solely on COVID-19. Rob, it's great to have you with us. Thanks for taking the time to join us.
Thank you very much. Very happy to be here.
All right, and let's go right through your slides here. The first one, taking a look at earnings growth. What are you watching here?
Well, like always, it's about fundamentals. Obviously, the market right now cares about other things, but I'd argue it's an extension through to fundamentals. So heading into the year, the market was fairly optimistic around 2020 profit expectations. And obviously, the market is discounting both the economic impact from the virus and what that means for corporate America profitability. I guess my overarching concern is we really don't have visibility into what the economic impact will be, and our current discounting mechanisms too conservative.
Yeah, and if we take a look at the next slide here, you're calling this mind the gap, because when companies report, there are two different kinds of reporting. You have non-GAAP, which is essentially what we base against consensus. And then, of course, you have GAAP earnings. What are you seeing here, that the divergence between the two?
So this is something that I had been talking about, or we had been talking about for some time, which is at an overarching level before the crisis, our belief was the quality of cash flows that investors were buying, because at the end of the day, that's what investing is. Whether you're buying a municipal bond issuer or public equity or private debt or public equity, it's all about future cash flows. And our belief was going into 2020, investors were overpaying for what we thought was below average cash flows. And what I mean by that, which is what you're referring to, is that the tremendous strength of American corporate profitability this cycle, which is no argument how tremendously strong it's been historic, but it didn't come from blocking and tackling, selling widgets, raising the price on those widgets. It came from other factors: financial engineering, buybacks, cost cutting, all those things that companies were supposed to do. But when you look through, what's the durability of that? And I guess one measure to try to get at that quality, which I highlighted in that piece, is if we just look at the differential between what companies say they're earning, which is ignore this one-off, ignore this write-down, ignore this bad investment, versus what they're earning per GAAP, there's always a difference between the two, because there are times during the business cycle or during a company's life cycle where they make mistakes or they do things that really aren't material to the long-term value of the business. And investors are supposed to brush that off, or supposed to ignore those things. And what I was just trying to point out, though, is that there was an increasing number of ignore this, ignore that in corporate earnings. And I was using that just as a directional proxy for the quality of earnings or the quality of profits is lower than what people may think.
All right, and if we move along to our next slide here, a big part of the conversation around really drilling down into companies' earnings and their balance sheets, now that's been exposed with the COVID-19 virus, working capital flow has been a big part of that narrative. And here you're looking at reverse factoring.
Sure. So going back to my comment a moment ago, when we think about all the levers that companies pulled, if we just simplify, there's balance sheet levers, there's income statement levers, there's working capital levers. And what reverse factoring, or also known as supply chain financing, is referring to is just the financing of payables. And it's not new. I'm not suggesting that it's nefarious in any way, shape, or form. It's just that the level of supply chain financing has gone up tremendously the last 4 or 5 years, again, in the absence of real material revenue growth. And we can blame that on the economy. We can blame that on commoditization from technology. We can source it from a lot of things. But what's happening, though, is an increasing part of companies, whether it's working capital, free cash flow, strengthened EBITDA, whatever metric you want to look at, it's come from other sources. And one of those other sources has been supply chain financing or reverse factoring. And now that we have a pretty significant liquidity squeeze happening here and in lack of credit availability, I think you're going to see a significant decline in companies' ability to factor their payables. And we'll see what Wall Street's response to that is when they see lower margin, lower earnings, lower working capital as a result of this.
All right, and let's wrap up with your final slide here. And this is something that you had touched on earlier. Buybacks really have driven earnings and really has suppressed those earnings variability. So let's wrap up here and expand upon that.
Sure. So obviously the level of buybacks isn't a new narrative. Many other strategists, investors, and central bankers have been talking about the excessive leverage that companies have taken on. I guess the way I think about it is that the top of companies' capital structure has expanded. So that would be the debt profile, while the bottom of a company's capital structure has shrunk. So essentially, you're shifting wealth down the capital structure. So what companies have been able to do, thanks to low interest rates, thanks to a tremendously large global savings glut, combined with low yields, creates a supply-demand imbalance. So companies were able to fund this by very willing bond and credit investors. And not only does it obviously improve earnings per share growth, but what I was trying to argue in the piece is that it also depresses earnings volatility. And that's pretty important because it's not just earnings strength that matters, but it's volatility that matters too. So you've got an upward pressure on earnings. Again, that's really not repeatable. And you've got downward pressure on earnings volatility that I don't think is sustainable either. And again, COVID-19, the liquidity squeeze, I think that's going to take a lot of that off the table.
All right, Rob, all great points. Thanks so much for joining us on Trade Talks.
Yeah, thank you very much.
All right, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.